Welcome back to Global Macro Pulse. If you are looking at your screens right now, you are probably seeing a sea of red that we haven't witnessed in, well, quite some time.
A sea of red is putting it mildly.
We need to talk about the violence of today's price action because, quite frankly, what we just watched in the precious metals complex, it wasn't a correction, it wasn't a dip, it was a liquidation event.
It was a slaughter. There is no other word for it. We've been tracking these volatility skews for weeks, warning that the positioning was getting, a bit crowded.
A bit crowded, yeah.
But to see spot gold shed over $100 intraday that's rare. And to see it crash through the critical $4,800 floor like it wasn't even there, that changes the technical landscape fundamentally.
It's not even the main story.
Oh, not even close. Then there's silver.
Silver is the headline today. I mean, gold is the king, right? It's the reserve asset. But silver is the volatile cousin that tells you when the plumbing is broken.
Absolutely. The canary in the coal mine. Silver collapsed nearly 20% in a single session. It's hovering near $70 right now. When you see a 20% move in a major commodity in one trading day, you are not looking at fundamental repricing.
No.
You are looking at a forced liquidation. Someone, somewhere, just got tapped on the shoulder hard.
And that tap on the shoulder is exactly what we're framing today's deep dive around. We are calling this the liquidity flush.
A good name for it.
Because we have the catalyst. The CME, the Chicago Mercantile Exchange, stepped in like a referee blowing the whistle on a bar fight. They're hiking margin requirements.
Yep, there's the trigger.
But as we always say here, the exchange intervention is just the symptom. The real story is why that leverage was there in the first place and why it unraveled so fast.
It's the perfect storm. You have the margin hike, sure. But you have to connect that metals crash to the broader risk-off sentiment we're seeing everywhere else.
It's not happening in a vacuum.
Not at all. Yeah. We have U.S. labor data that just dropped this morning, and it is, to put it mildly, shocking. We have central bank paralysis over in Europe, and we have what looks like a geopolitical peace premium suddenly hitting the oil markets.
Exactly. It's a convergence of factors.
Yeah.
We have the precious metals slaughter, a 17-year high in U.S. layoff announcements, which we will absolutely unpack in detail because that number is terrifying. And then we have the energy sector just rolling over.
It's a risk-off cascade.
This is breaking news that requires immediate portfolio defense. If you're holding leveraged longs, the game changed as of the close today, Thursday, February 5th.
The whole dashboard is lit up, I think. I think we need to go through the technical damage first. That's where the bleeding is happening right now.
Let's start there. Segment 1, the precious metals capitulation. Walk us through the carnage on the charts today. What are the key levels we lost?
Okay, let's get into the numbers. Looking at the close for Thursday, February 5th, U.S. Eastern Time, spot gold closed down 3.73%. We are sitting at $4,779.41.
Now, for anyone who mostly follows equities, 3.7% might sound like just a bad day in the NASDAQ.
Right.
In the gold market, which is supposed to be a store of value, that is a massive, massive volatility expansion.
It's a huge move. But the real story is the level. We lost the 4,800 handle.
4,800 has been that psychological floor for weeks. Every single time we dipped near it, you saw buyers step in. It was the value zone where the algos, the discretionary traders, everyone showed up.
Exactly. It was the line in the sand. It was both psychological and, key technical support. We breached it intraday, fell well below, and crucially, we closed below it.
The close is what matters.
The close is everything. It tells me the buyers who were defending that level have either exhausted their ammunition or, and this is more likely, they've been stopped out. When you break a level that has been tested 5, 6, 7 times, it just creates a vacuum. All those stop-loss orders.
Right.
Everyone who bought at, say, 48.10, 48.20, they all had their stops sitting right below 4,800.
So once it ticked 47.99?
Snap. It's a cascade. A wave of sell orders hits the market all at once. And because it happened during a period of stress, there were no bids. There were no buyers on the other side. That's why you get that vertical red line on the 5-minute chart. Just a straight drop.
An air pocket.
Total air pocket.
Ah.
But if you think gold looks bad, you need to pull up the silver chart.
I'm looking at it. It looks like a crypto chart from a bear market.
It really does. I was thinking the same thing. Silver imploded, down 19.68% to close at $70.79. It even touched a low near 70 flat.
Almost 20%.
Almost 20. And when you look at the volatility skew here, I mean, we are talking about a move that is multiple standard deviations outside the mean.
Okay, so break that down. Explain standard deviation in this context for our listeners who might not be quants.
Sure. Standard deviation essentially measures how normal or abnormal a price move is compared to its own history. A 1 standard deviation move happens all the time, pretty normal. A 2 standard deviation move is rare.
And this move in silver.
This is way out in the tails of the bell curve. This is a 3, maybe even a 4 sigma event. It tells us it wasn't fundamental. It wasn't that everyone woke up this morning and decided that solar panels, which use a lot of silver, are suddenly useless.
Right. Industrial demand didn't just vanish overnight.
Not a chance. This was forced selling. You don't sell silver down 20% because you changed your mind on the macro outlook. You sell because you have to. You sell because you got a call from your broker.
A margin call.
This has all the hallmarks of a major fund blowing up or a massive stop-loss cascade where the algorithms just hunted for liquidity all the way down and they found none.
It feels like a margin call cascade. And that brings us perfectly to the structural trend. We got the news from Chicago. The CME Group is hiking margins.
That's the headline. After the fact, of course. The CME is raising collateral requirements for gold and silver futures.
And when does that kick in?
This goes into effect after the close on February 6th, which is tomorrow, Friday. But markets are forward-looking mechanisms. They don't wait for the official announcement.
They sniffed it out. Someone always knows.
They absolutely did. Or it leaked. Or, frankly, the smart money just knew that volatility was getting too high, and the exchange would have no choice but to act. It was predictable.
So what are the new numbers?
Okay, here they are. Gold margins are being hiked to 9%. Silver margins, they're being hiked up to 18%.
18%. 18% margin requirement for silver. That is a massive, massive capital call for anyone holding a levered position.
It's huge.
Let's play that out for a second. If I'm a trader, maybe a hedge fund, and I'm holding a $10 million position in silver futures.
Okay, so before today, you might have needed, let's say, $1.5 million in cash to hold that position. Now, the CME comes out and says, no, we need $1.8 million. You have to find $300,000 in cash per $10 million of exposure overnight.
And if you don't have it, liquid.
If you don't have it, your broker sells your position for you at market. And they don't care about the price. They just hit the bid until your position is gone.
And if everyone is a forced seller at the same time?
You get a flash crash, which is exactly what we saw today. The market front-ran the margin call. Traders knew that come Friday close, the cost of holding these leveraged long positions would skyrocket, so they just dumped them on Thursday to avoid the pain.
What's so fascinating here, and also so tragic, is the divergence between this professional, leveraged washout and what the retail investor is doing. We just got the data from the World Gold Council for January's ETF flows.
This is the part of the cycle that's always so hard to watch. The World Gold Council reported that in January, global gold ETFs saw inflows of $18.7 billion.
Say that number again.
$18.7 billion, with a B. That is an all-time record.
A record. So retail investors, maybe some smaller institutions, they were piling into gold at the absolute highs.
It's the classic bull trap. The crowd piled in right at the top, completely driven by FOMO, fear of missing out, and all the geopolitical narratives we've been discussing for months.
And in doing so, they provided the liquidity for the smart money to exit their positions.
Precisely. The professionals sold to the retail buyers.
Yeah.
And now those record inflows are deeply underwater. The people who bought in January are now sitting on significant losses, which, creates overhead supply.
Explain what that means, overhead supply.
It means that any rally back toward $4,800 is likely to be met with a wall of selling. It's from all these trapped longs who are just desperate to get out at break even. They're not looking for a profit anymore. They're just looking to get their money back.
So that level, 4,800, which used to be support, it's now resistance.
It's now a ceiling, a very heavy one.
This all raises a bigger question about systemic risk. Is this just a healthy clearing of froth? We often say markets need to shake out the weak hands. Or is silver dropping 20% a sign of something deeper, something breaking in the system?
I'm arguing it's stress in the plumbing. I really am. When you see a 20% dislocation in a major asset class in a single day, it suggests that collateral chains are breaking.
Right.
Remember, silver isn't just a shiny metal you hold in a vault. It's an industrial input, and it's also a financial asset used as collateral in other trades.
So if the value of your collateral just dropped by a fifth overnight,
you might get margin call on other trades. Your stock positions, your bond positions, your currency hedges, This is how a contagion starts.
Mm.
It's not just about a bad trade in silver. It's about the liquidity that just evaporated from the entire system.
Stress in the plumbing is the phrase that keeps me up at night. And speaking of stress, we have to pivot to the U.S. economy. Because while the metals market was melting down, we got a data print from the labor market that, quite honestly, signals a regime change.
We did. You know, we've been talking about the soft landing narrative for, what, a year now?
At least, the market was priced for absolute perfection. Inflation comes down, unemployment stays low, the Fed cuts rates, and everyone wins.
Well, the data we got today from Challenger Gray and Christmas, it drives a stake through the heart of that narrative. It's over.
Let's get to it. The Challenger report for January layoffs. Give us the number.
The headline number is 108,435.
Wow.
That represents over 108,000 planned job cuts announced in January alone.
And what's the context? How does that compare to last year? Let's get the year over year.
It's a 118% increase year over year. More than double the layoff announcements from January of last year.
More than double.
But the historical context is even more alarming. This is the highest January total we have seen in 17 years.
17 years. So you're saying since 2009.
Since 2009. We are referencing the depths of the great financial crisis.
So we are now officially seeing crisis-era data prints in the labor market.
That's right. When you see layoff announcements matching GFC levels, you cannot, with a straight face, argue that the labor market is resilient. That word needs to be retired from the financial lexicon.
It's not just the firing side, is it? It's also the hiring side. We got the Joel Tease data, the job openings, and labor turnover survey as well.
Right, and it tells the other half of the story. Job openings fell to 6.542 million. That is the lowest level we've seen since September 2020.
September 2020. Let's remember what that was like. We were still in the thick of the pandemic lockdowns. The economy was barely reopening.
Exactly. We were back to those levels of demand for labor.
Yeah.
The vacancy to unemployed ratio is just collapsing.
There was this concept the Federal Reserve, and specifically Chair Powell, loved to talk about, the vacancy to unemployed ratio. He used to cite it in every single press conference. There are 2 jobs for every unemployed person, he'd say.
He hung his hat on that. It was his entire justification for keeping interest rates so high for so long. He argued the labor market was too tight, that it would fuel wage inflation.
Well, what's that ratio look like now?
It's collapsing.
Yeah.
We are rapidly approaching a 1-to-1 ratio, and once you cross below that, you lose all wage pressure, workers lose their bargaining power, the whole dynamic flips.
So let's put this together. Companies are firing people at the fastest rate since 2009, and they are hiring at the slowest rate since the pandemic. We have moved from labor hoarding,
Which was the post-COVID phenomenon, yeah.
where companies held on to workers because they were afraid they couldn't hire them back, to outright labor shedding.
Correct. The hoarding is over. Corporations are now protecting their profit margins by cutting heads. It's a classic recessionary spiral. You see demand fall, so you cut costs, which means laying people off, which in turn causes demand to fall even further.
And this is broad-based, right? This isn't just the tech sector anymore.
No, that narrative is old. We are seeing it in retail, in finance, in logistics, manufacturing. When you see broad-based firing, it means demand is drying up across the entire economy.
This puts the Federal Reserve in an absolutely brutal box.
The Fed is completely, utterly behind the curve. We have been saying this for months. They are fighting the last war. They are still worried about inflation ghosts from 2 years ago, obsessing over decimal points in the CPI report.
While the other half of their dual mandate, the employment mandate, is flashing bright red.
It's a 5-alarm fire. If they don't pivot and pivot hard, they risk driving this economy straight into a hard landing.
Is there even time? Hasn't the damage already been done?
They might have already missed the window. Monetary policy acts with a lag, right? A long and variable lag. If you cut rates today, it takes 12 to 18 months to fully filter through the real economy.
And these layoffs announced in January?
They become unemployment claims in March and April. They become mortgage defaults in the summer. The damage is already baked in. The windshield is showing a cliff, but the Fed is driving using the rearview mirror.
And the next domino, of course, is the consumer. We have the University of Michigan sentiment data coming out. That's Friday. What time?
It's due Friday at 23:00 Eastern Time, and that is the one to watch.
Because the U.S. economy is 70% consumption.
It's everything. If people are worried about losing their jobs, or if their neighbor just lost their job, they stop spending. It's that simple. They cancel the vacation. They don't buy the new car. They trade down at the grocery store. If consumer confidence cracks alongside these layoff numbers,
Then the recession isn't a risk anymore.
it's a base case. It's here.
It's a grim picture for the U.S., but let's look across the Atlantic. Because if the Fed is trapped, the European Central Bank and the Bank of England look absolutely paralyzed.
Policy paralysis is the perfect term for it. Let's start in Frankfurt. The ECB, earlier today, decided to keep all three of their key interest rates unchanged.
No surprise there, really, but the reasoning, or the lack of a cut, is what's so interesting. Why aren't they cutting rates to try and stimulate growth? I mean, the European economy is arguably in worse shape than the U.S. Germany is basically stagnating.
It's fear. It boils down to one thing: fear of the currency. Christine Lagarde is in a staring contest with Jay Powell.
Explain that.
If the ECB cuts interest rates and the Fed stays higher for longer, the interest rate differential widens and the euro collapses against the dollar.
And that imports inflation.
Exactly. Energy is priced in dollars. Most commodities are priced in dollars. So a weaker euro means higher inflation in Europe. So the ECB is trapped. They need to cut to help growth, but they can't cut because of inflation and currency risks.
So they do nothing.
They do nothing. They sit on their hands while the German manufacturing base, the engine of Europe, grinds to a halt.
It's a policy hostage situation, and then you have the drama over in London at the Bank of England. They also held rates, but that vote, that was a nail-biter.
It was incredibly close. The implied split was 5-4. A single vote kept rates steady. If just one member of the committee had flipped, we would have seen a rate cut today from the BOE.
That shows you just how divided the committee is on what to do next.
It reflects the absolute mess the UK economy is in. They also downgraded their economic growth forecasts, which were already lackluster. This is the textbook definition of stagflation.
Low growth, sticky inflation.
You have low growth, sticky inflation that just won't go away, and a central bank that is split right down the middle on what to do. Half of them want to cut to save growth. The other half want to hold firm to kill inflation. You can't do both.
Governor Andrew Bailey's comments after the meeting were interesting, to say the least. He said a 50-50 bet on a March cut is not too bad.
That is classic central bank obfuscation. It's a word salad. He's basically telling the market, your guess is as good as mine.
It inspires confidence.
Not at all. He's saying the market should price in a cut, but the data volatility makes it a total coin toss. That doesn't instill confidence. Investors and businesses hate uncertainty. When the governor of the Bank of England tells you it's a coin flip, volatility premiums go up across all UK assets. It makes it more expensive to do business because you just can't plan.
And it adds to that global risk-off feeling. The theme of the day, no one knows who is driving the bus.
The pilots are fighting over the controls.
So we have a liquidity flush in metals, a labor market cracking in the U.S., paralyzed central banks in Europe. Now, let's throw geopolitics into the mix, because usually when the world looks this unstable, oil bids up. War is inflationary, right? But oil is selling off hard today.
That's the big divergence, and it's a really important one. WTI crude fell 2.14% today to $63.16. Brent is down a similar amount, sitting at 67.04. WTI even tested a low of 62.70.
Technically, the chart for oil looks broken. Every single rally for weeks has been sold into.
The trend is firmly bearish. And this is happening despite conflict risks in multiple theaters that would normally send oil screaming to $80 or $90 a barrel.
So the market is ignoring the geopolitical noise.
It's ignoring the noise and focusing on two things: the demand destruction from the looming recession we just talked about, and a new catalyst for the sell-off, the peace premium.
This is the counterintuitive part. Peace is bearish for commodities.
Exactly. For the last 2 years, oil has had a war premium built into the price. Traders assumed that supply disruptions were inevitable, a matter of when, not if.
And now that's being priced out.
Rapidly. We have news of direct talks between the U.S. and Iran scheduled for Friday in Oman.
Direct talks,
Yeah.
that is huge. The risk of a closure of the Strait of Hormuz has been keeping a floor under oil prices for a long time.
It has. It's the most important choke point for global oil. If the U.S. and Iran are talking, that immediate escalation risk diminishes significantly. The market is pricing out that fear premium as we speak.
And it's not just the Middle East, is it?
No. President Zelensky of Ukraine mentioned today that the next round of trilateral talks, that's Ukraine, Russia, and the U.S., could potentially be held in the United States.
Wow. That signals a very serious diplomatic push is underway.
It does. And you have to think about the supply implications. If the war in Ukraine winds down, or even just freezes in place, supply chains start to normalize. And we heard Treasury Secretary Yellen mention that the sanctions on Russian oil are directly dependent on the progress of peace talks.
So if sanctions ease, even a little bit, Russian oil flows more freely into the Western markets.
And suddenly, the supply glut narrative, which has been lurking in the background, becomes the primary story again.
So let me get this straight. Peace breaks out, sanctions potentially lift, supply floods the market, and at the same time, demand is crashing because of the recession we just talked about.
That is the recipe for $50 oil,
Mhm.
maybe even lower.
And we can't ignore the Trump factor in all of this. He's not even in office, but he's already shaping the narrative. He made some pretty direct comments regarding the upcoming Japanese election.
He did, supporting Sanaita Kaijiki. It's pretty much unprecedented for a U.S. leader or former leader to weigh in so directly on an internal election in a country like Japan. He said the result is critical for the future.
What's the signal there?
It signals that Trump is already building his global trade alliances for a potential second term. He wants specific leaders in place who align with his worldview. This adds another layer of complexity for markets. Is he building a block against China? Is he preparing for a new framework of trade deals? Markets are trying to price in Trump policy before it even happens.
It all feeds into this feeling of a global realignment. Okay, I want to zoom in now from the big macro picture to the corporate side, because while the macro is messy, the micro, what companies are actually doing with their cash, tells us where the future is heading. And we have a monster number from Amazon.
A staggering number. Amazon is projecting $200 billion in capital expenditure capex for the year.
200 billion. Let's just pause on that. That is the GDP of a mid-sized country. Greece's GDP is around that level. Amazon is spending the equivalent of the entire Greek economy on what exactly?
It is the AI arms race in pure dollar terms. They are spending on data centers, on custom silicon, on the energy infrastructure to power it all.
That's deflationary for their own free cash flow in the short term, right? Investors might not like that burn rate.
Correct. But it is massively inflationary for the hardware sector. If you are a supplier to Amazon, if you're selling them copper wiring, cooling systems, NVIDIA chips, this is a gold rush.
But speaking of chips, we saw a little wobble today in the king of the sector, NVIDIA.
We did. The information reported that NVIDIA is delaying a new gaming chip. The stock ticked down about 1%, which is pretty mild for them, but it raises an important question.
Is it a supply chain bottleneck returning?
That's the worry. Are they having trouble with the advanced packaging from TSMC? Or, and this is the more bearish take, is this a demand management tactic? Are they seeing a slowdown in the high-end gaming segment and deciding to push the launch to a better time? In this market environment, any sign of weakness for the market leaders gets magnified.
And speaking of corporate activity, we saw some interesting M&A, or rather, some M&A confusion. Meituan is acquiring Ding Dong Fresh for about $717 million.
This deal is fascinating, but not for the deal itself. It's because of the market reaction. Usually when a company gets bought out, the target company's stock rips higher to match the offer price.
Right. The arbitrage traders come in and close that gap. It's supposed to be free money.
But look at Ding Dong's ticker, DDL. It fell 14% in U.S. trading today.
That is bizarre. You get the news you're being bought out and your stock crashes. How does that work?
It signals deep, deep skepticism from the market. There are two possibilities. Either the market doesn't believe the deal will actually close, maybe there are regulatory hurdles, maybe financing issues with Meituan,
Or
the speculator community was positioned for a much higher buyout price. They bought the rumor of a buyout, expecting a big premium, and the actual price was a disappointment. So they just dumped the stock.
it's another example of how sell the news is the dominant strategy right now.
Nobody trusts anything. Even a confirmed buyout offer isn't good enough to hold the stock. Cash is the only thing people want.
And another, much bigger deal fell apart completely. Rio Tinto and Glencore.
That one collapsed due to valuation gaps. And this connects right back to our big inflation versus deflation debate. The sellers, in this case, Glencore, want an inflation premium. They look at their assets, their copper mines, and say, these are real assets. They're worth more in a world of fiat currency debasement.
But the buyers, Rio Tinto, are looking at the recession risk we just discussed.
Then they're saying, we want a recession discount because global demand for these commodities is about to crash.
So the bid-ask spread is just too wide to bridge.
Exactly. When major buyers and sellers can't agree on the fundamental value of a copper mine or a coal asset, it tells you that price discovery in the market is broken. No one knows what anything is actually worth because the macro signals are so conflicting.
So, bringing this all together for our listeners, we have a liquidity flush in precious metals, a labor market that is clearly cracking, central banks that are paralyzed, a peace premium hitting oil, and corporate deal making is freezing up because of valuation uncertainty. What are we looking at for tomorrow, Friday the 6th?
Friday, February 6th is going to be volatile, no question. The CME margin hikes officially kick in after the close, so we might see more positioning and squaring up throughout the U.S. session as people try to get their books in order.
Any key data points?
On the data dashboard, I'm watching two things very closely.
Hit us.
First, the University of Michigan's inflation expectations. That's at 23:00 Eastern Time. If that number ticks up, if consumers start to expect higher inflation at the same time the jobs market is crashing, we officially enter stagflation territory.
And that is the absolute nightmare scenario for the Fed.
It's their worst nightmare. They can't cut rates to save jobs if inflation expectations are becoming unanchored.
And the second thing you're watching?
Rig counts. The Baker Hughes rig count comes out at 02:00 Eastern Time, which will be Saturday morning. With WTI oil at $63, U.S. shale producers are bleeding cash. We need to see if they're finally laying down rigs.
What's the signal there?
If production capacity starts to drop, that could put a floor under oil prices. But if they keep drilling at a loss, trying to maintain market share, then oil has much further to fall. $50 is very much in play.
It really feels like the regime has changed. The whole playbook has been thrown out.
It has. We are moving from a buy-the-dip mentality, which, let's be honest, worked for a decade, to a sell-the-rip mentality. Look no further than gold. Record inflows from the public, yet the price crashes. That is the disconnect.
The retail investor is still playing by the old rules.
They're trying to catch falling knives. And meanwhile, the institutional capital is moving to cash, waiting for the dust to settle.
So for the listener driving home or heading to the office, what is the one single thing they should take away from today's chaos?
Vigilance.
Mm.
Just be vigilant.
Okay.
Don't assume that what worked in 2024 or 2025 will work in 2026. The correlations are all changing. Bonds might not hedge your stocks anymore. Gold might not hedge chaos, as we saw today. In this environment, cash is the only asset with zero correlation to a margin call.
There's an old saying, cash is an option on future distress. That is a powerful mental model right now. It means holding cash isn't doing nothing. It's actively waiting for a better price on distressed assets.
Exactly. Don't try to catch a falling knife. Wait until it hits the floor, bounces, and stops vibrating.
Yeah.
Let the margin calls clear. Let the leverage flush out of the system. There will be incredible opportunities on the other side of this, but trying to front-run a margin call is a good way to get run over.
Stay safe out there. Watch the levels. 4,800 on gold, 63 on oil. These are the new battlegrounds. Stay liquid and stay skeptical. This is Global Macro Pulse.
And as always, nothing we discussed today constitutes financial advice. Please do your own research.
We'll see you on the other side of close.